Hello, I'm Ken Moray, Senior Retirement Planner and founder of Retirement Planners of America. And with the Secure Act having been enacted at the end of last year, there are some significant planning opportunities and challenges that have been created. And in fact, in this series, we've got 3 videos for you with regard to estate planning. And we're entitling these a potential tax time bomb for you and your beneficiaries. Now, this is part 1, where what I want to do in this video is just kind of give you what has transpired. What are the changes that potentially could create this tax time bomb? Well, the big deal is that the stretch treatment of IRAs has been eliminated and has been replaced with a 10-year rule. So let me kind of explain what the stretch treatment is. So the old law said that once somebody inherited an IRA, they had to take out what are called required minimum distributions. But those required minimum distributions were based on their life expectancy. They had to take out a little bit every year over their lifetime. And that's why the expression stretch came about, which means that you can stretch the IRA out over the rest of your life. However, the 10-year rule says you can't do that anymore. Now you have to take it all out by the 10th year, by the end of the 10th year. So this changes everything, because now if you don't take, now what they've said is that you can take that money out of the IRA as an inherited IRA. So this is somebody who has inherited the IRA. You can take the money out at any time you want, but you have to take it all out by the end of that 10th year. So if you didn't do any of those, if you haven't taken any out, then guess what? In that 10th year, you got to take it all out. And depending on the size of the IRA, that could be a big amount, which could create a huge tax, therefore the tax time bomb. Now, this does not apply if to spouses, okay? So spouses can inherit and there's no issue there. Anyone who is disabled, a chronically ill person, individuals who are not more than 10 years younger than the person that passed. So if you're inheriting an IRA or someone inherits from you and they're not 10 years or more younger than you, then the 10-year rule doesn't apply. They can still stretch, and certain minor children as well. The 10-year situation creates some planning opportunities if you inherit an IRA or if someone is going to inherit from you. One of them being that, let's say you have somebody who is working, inherits the IRA, and is planning on retiring in 5 years, and they're making a good living right now. Well, during the next 5 years, while they're making that good income, that would not be a good time to also take out money from an IRA and increase the amount of your taxable income. So in that situation, this person may want to wait until year 6 and then take it out in 6, 7, 8, 9, 10, and therefore when they're in the lower tax bracket. So there are some planning opportunities, there are some ideas on how to do that, and so it's important that given this new law and the changes that it brings with it, that you talk with a professional who understands these things and can take your individual account into the process. So I encourage you to go to our website. It's rpoa.com, where you can find resources and the ability to visit with one of our retirement specialists. So rpoa.com is our website, and thank you for watching this video. Make sure you watch part 2 and part 3 as well, because there's more.